Motilal Oswal S&P BSE Quality Index Fund, NFO. Can you add this NFO to your portfolio, or do you have to avoid this NFO in your portfolio? Let us evaluate. Hi, this is Ramalingam, Certified Financial Planner from holisticinvestment.in. We help individual investors like you to take a right financial and investment decision so that you can reach your financial goals faster and smarter. In this video, we will have three segments. In the first segment, let us understand some of the key features of this NFO. In the next segment, we will analyze the performance of this BSE quality index. Because this is an NFO, there is no portfolio, there is no track record, but being an index fund, if we analyze the performance of the index and the portfolio of the index, that will give us complete idea. Then in the third segment, we will analyze pros and cons, potential merits, demerits of this fund. Let us go to the first segment. The first segment is key features. This fund is open till 12th August 2022. It is an equity fund coming under index fund category. The benchmark index is BSE Quality Index. Here the minimum investment is just 500 rupees and the fund manager is Swapnil Mayekar. And there is an exit load of 1% if you withdraw before 15 days. That means after 15 days there is no exit load. What is the investment objective of this fund? The investment objective of this fund is to simply mimic, replicate, cut, copy, paste the BSE Quality Index. They will buy the same set of stocks in the BSE Quality Index in the same proportion. Subject to tracking error and expense ratio, this fund will deliver similar return to the BSE Quality Index. Now we have understood the key features of this particular fund, and now we'll move on to the second segment. In the second segment, we will analyze the index. First, let us understand what is the basis by which this index is constructed. This particular index, BSE Quality Index, has got constructed by selecting quality stocks from S&P BSE Large Mid-Cap Index universe. So from the BSE Large Mid-Cap Index, they will pick and choose best quality stocks based on quality score. How this quality score is assigned? Based on return on equity, accruals ratio, financial leverage ratio. Based on these quality scores, whatever the top companies, that will be selected for S&P BSE Quality Index. What are all the top 10 companies by weightage in this particular index? Let us see here. ITC, Britannia Industries, Bharat Electronics, Nestle, Coal India, Page Industries, Marico, IndusInd Bank, BPCL, TCS. Top 10 companies accounts for 53.2% of the overall portfolio. Overall portfolio, 53% of the assets is getting invested in 10 stocks. Then the top sectors are FMCG, commodities, information technology, energy, industrials, financial services, healthcare, consumer discretionary. Whereas FMCG, commodities and information technology are the top three sectors, they account for 52% of the overall assets. So from the individual stock wise as well as individual sector wise, this particular index has got concentration. This concentration can add additional return. This concentration can add additional risk also, that we have to be cognizant. Then in the last 1 year, this index has delivered -4%. Last 3 year average return is 13%. Last 5 year return is 9.8%. Last 10 year return is 15%. So being an equity fund, this fund can be volatile in the short run, can give you negative returns also in the short run. However, in the long run, this fund can give you above average inflation beating return. This fund can give you. So Only if you have long-term money and long-term goals, you can invest in this fund. If you have only short-term money or short-term goals, then you should completely avoid this fund. Okay, we have done now the complete analysis on the index. Its stocks, sector, past performance we have analyzed. Now we can move on to the third segment. In the third segment, we will analyze the pros and cons of this fund. What are the advantages of this fund? Let us analyze one by one. Quality stocks, quality companies will outperform in the long run. So quality is definitely one important attribute of long-term performance. Being an index fund, this fund will have lower expense ratio compared to the actively managed fund, because in the actively managed fund, the fund manager has to do in-depth research. So there will be more research expenses there. Whereas here, the fund manager is will not do any kind of research. He will simply copy, paste the index. So research expenses will be very minimal. Because of that, fund management expenses will be very low. And this is a factor-based fund, right? Though it is an index fund, it includes a factor called quality. There are other factors like value, enhanced value, momentum. So when we include these kind of factors, that can help you generate better risk-adjusted return. So without a human intervention, by just following few observable data, this particular index is able to systematically add quality stocks and also able to remove non-quality stocks. This fund is free from fund manager bias. There is no stock selection risk. The fund manager will not pick and choose the best stocks. Normally in the actively managed fund, the fund manager will pick and choose the best stocks. So when he does his analysis, if he commits a mistake, he may end up choosing the wrong stock. So this is what known as stock selection risk or fund manager bias. This fund is not having such a risk, because here fund manager is not going to do any selection. He is going to simply copycat the stocks in the index. So there is no fund manager bias or stock selection risk here. When we add factors like quality, it will reduce the downside risk and has got the potential to increase the return. So risk adjusted return will be relatively better here. High quality actually translates into lower risk comparatively. Normally in the when we add more weightage to the quality, more emphasis on the quality, it can reduce obviously the downside risk. See, wealth destruction can happen predominantly in non-quality stocks. In quality stocks, the possibility of wealth destruction happening seems to be very low. Now, we will look into the potential demerits. As an investor, we should not be overshadowed by the positives of any investment options. We have to look at the negative factors also. What are all the disadvantages, potential demerits? We have to look at it. One is this fund is riskier for short-term investors. Being an equity fund, it will be volatile and has got the potential to give you negative returns in the short run. Because of that, if you have got short-term money, you have to avoid this fund. And if you are a beginner investor, if you are a conservative investor looking for a fund to add in your core portfolio, again, this fund is not suitable. Because in a core portfolio, what actually happens? You need a very broad-based index fund or a well-diversified equity fund, and not factor-specific, slightly concentrated, smart beta kind of index is not suitable for your core portfolio. Being an index fund, this will simply replicate the index returns. This will not give additional return than the index. There is no alpha generation possible. Whereas in the actively managed fund, the fund manager will try to outbeat the index and generate alpha. So here, there is no possibility of alpha generation. The fund manager will mimic the index and deliver almost similar return to the index, subject to tracking error and expense ratio. So because of tracking error and expense ratio, this fund will deliver slightly lesser than the index returns. You can't expect a flexible dynamic fund management from this fund. Being an index fund, they have to follow same set of stocks, same set of sectors in the index. If you, as a fund manager, think this particular sector's outlook is very dull, but higher exposure is given in the index, he has to simply follow the index. He can't implement his outlook. If a particular stock's outlook is very dull, but it is there in the index, he has to buy that stock regardless of his outlook and analysis. So that way, in the actively managed fund, the fund manager will be able to reduce the exposure from the sector where the outlook is dull, and he can increase the exposure where the outlook is bright. Similarly, he can come out of a stock which seems to be deteriorating. He can invest in a stock which is very promising. He can increase the weightage. It is not possible in the index fund. He can't do any dynamic fund management changes. He has to simply follow the index. He can't do anything outside the index. Also, most of the times, quality stocks will be expensive comparatively. Quality stocks are known stocks, obvious stocks, not the value of the stock is not known to the mass. Most of the analysts will be tracking these kind of quality stocks. So that way, quality stocks will not be available at undervaluation. They will be either available at fair valuation or at the overvaluation. Most of the times they will be available at overvaluation. If you take stocks like Nestle, definitely they are not available at a fair valuation or undervaluation. Nestle is there in the portfolio. So at an expensive rate, this fund has to invest in quality stocks. Quality is important, but at the same time, at what value we are buying should be given enough weightage. This fund, when we looked at the sectoral allocation and the top 10 stocks, we realized that this particular fund has got concentration in the stock wise and also in the sector wise. That has to be addressed. Right? Concentration can bring additional return and also can bring additional risk. The fund manager here will not do any analysis on the underlying stock, on the balance sheet. He has to simply mimic the portfolio in the index. Normally in the actively managed fund, the fund manager will analyze the profitability, balance sheet, sustainability, capital efficiency, value proposition, competitive edge, all these factors, management quality, they will analyze and then they will pick and choose. Here, there is no such in-depth analysis. Here, he has to simply take all the stocks in the same proportion from the index. So the fund manager is forced to take blind risk. In the actively managed fund, the fund manager will be able to do better calculated risk. He will be taking calculated risk. As an investor, like you invest in mutual fund, expecting that the fund manager will select best stocks and remove below average stocks from the portfolio. So that is not happening in Motilal Oswal S&P BSE Quality Index Fund NFO. For that matter, it is not happening in any of the index fund. So actively managed funds has got better position to take well calculated risk. That way they reduce downside risk and increase the margin of safety for investors like you and me. So we have done a complete 360-degree analysis on this fund. What is the final takeaway? Do we have to invest in this fund? Is it suitable for me or not? Right? Being a first-time investor and conservative investor, you should avoid this fund because this fund is not going to be suitable for your core portfolio. Being a first-time conservative investor, you have to choose a broad-based index fund or a well-diversified fund. Obviously, long-term investments in actively managed portfolios can produce better return than index funds. This fund is not suitable if you are looking for market-beating returns or dynamic fund management. Again, this fund is not suitable. Before deciding to invest in this NFO or avoid this NFO, please consult your financial planner, because your financial planner knows in your financial roadmap what are all your major financial objectives, financial milestones like buying property, kids' education, your retirement. So for your specific investment objective, this fund is suitable to you or not. He will be able to decide, analyze, and tell you. Also, being a financial planner, he knows about your risk profile, what kind of risk taking capacity you have, what kind of willingness to take risk you have got. Based on that, he'll be able to tell you whether this fund is suitable to you or not. Also, as a financial planner, he'll be able to tell you what kind of allocation to be given for these kind of funds in your portfolio. Third, you can request from your financial planner a specific report on overlap ratio, because you are adding this new fund. What kind of overlap or unique diversification this fund is going to bring to your overall portfolio? Right? You already have set of mutual funds. You may already have set of direct equities. Because you are adding this fund, like this fund is going to bring stocks like Nestle, Page Industries, ITC. Suppose if these stocks are owned by other existing mutual funds, or you also own it in your direct demat account, this is going to bring overlap. If you are not owning them, then it is going to bring unique diversification. This overlap or unique diversification is going to help your portfolio or not. Your financial planner will be able to analyze and tell you. So please ask him this overlap ratio report. Hope this analysis and evaluation on Motilal Oswal S&P BSE Quality Index Fund NFO helps you. If you have any additional questions related to this fund or any other investment options or anything related to achieving your financial goals, feel free to book a free appointment with our certified financial planner. The link to book the free appointment is given below this video in the description. Also, we regularly organize insightful investment webinars with eminent investment experts who have more than decades of industry experience. Right? They deliver sessions on investment strategies, wealth creation techniques, which you can learn from them and immediately apply in your portfolio. I have also given the registration link for the webinar below this video, and again this webinar is completely free to you. So please leave your name and email ID. I'll book the seat for the next webinar and send you the invite. Hope you like this video. I'll again meet you in yet another useful video. Thank you. Bye-bye.